and it's not part of the ledger system. Okay, learning objective 2.4. Describe valuation principles of the acquisition method. Okay. All right, the acquisition method is required to account for a business combination. If you remember what we talked about, it looks at and uses fair value of the acquirer's interest in the business. Makes a lot of sense. You're going to put it on the books, so you're going to record it at what you paid for it. Okay? Doesn't matter what the book values are of the acquired company. The acquisition method is focused on the fair value, not the book value. Okay? Applying the acquisition method involves using fair value to recognize and measure, first, the consideration transferred for the acquired business and any non-controlling interest. Second, separately identified assets and liabilities assumed. And then third, we have to determine whether there's been any goodwill involved in the purchase or whether there's a gain from a bargain purchase. Occasionally, you will actually pay less for the assets than they're worth, and that would be a gain. Okay, so let's look at fair value. GAAP requires that fair values of assets acquired and liabilities assumed in a business combination are to be determined as of the acquisition date. Okay, basically, what do we use fair value? How do we determine fair value? You go out and they use the price that they would pay for selling an asset or transferring liabilities in a transaction. It's based on what the assets are worth at that point in time. How do they go about valuing those? Okay, there's a couple different, ASC 820-10-35-28 tells you that there are 3 valuation techniques. Okay, first, the market approach estimates fair values using other market transactions involving similar assets or liabilities. So it goes out there and tries to identify other transactions that have occurred, what has been paid for them, and looks at what this transaction is involving and to see if there's possibly a way to use recent history to account for the current transaction. Another approach is to use future cash flows projected to be generated by an asset. So you could determine that and use that as your fair value of the asset. And the cost approach, the third one is the cost approach estimates fair values by looking at the current replacement cost of an asset with another of comparable utility. So you wouldn't go out and you bought a used machine. You wouldn't compare it to a new machine. You would go out and compare the value of the used machine to what you would pay for a like used machine in the marketplace. Okay, how do you calculate goodwill? Well, if the consideration transferred does not equal the fair value of the assets acquired, you could either have goodwill or a bargain purchase. If the consideration transferred, in other words, if you're paying more than the net assets and liabilities assumed, there must be some sort of goodwill. Because you're paying more, you think that the company's worth more than the tangible assets. So there must be something that's non-tangible that you would charge to goodwill. If your fair value of the assets acquired and liabilities assumed is greater than the consideration, so if you pay less than what the fair value of the assets are worth, you have a gain on the bargain purchase. And the gain is recognized as ordinary income by the acquiring business. Okay, objective 2.5. Determine the total fair value of consideration transferred for an acquisition and allocate that fair value to specific subsidiary assets acquired, including goodwill, and liabilities assumed, and then whatever's left over gets charged to a gain or a gain on bargain purchase, if there is anything. Okay, now I will tell you that the example that's going to be used throughout this the rest of the chapter is the exact same one that's in your textbook. So if you purchased a copy of the textbook, you might want to follow along. I will try and take some time and go back and forth between slides so you can understand it. Unfortunately, there's so much information, you can't put it all on one slide. So you do have to kind of refer back to slides as we go through this. Okay. All right, so what's happening here is BigNet agrees to pay cash of $550,000 and issue 20,000 previously unissued shares if it's $10 per common stock, which is currently selling for $100 per share, for all of Smallport's assets and liabilities. Okay, following the acquisition, Smallport then dissolves itself as a legal entity, and the consideration transferred from BigNet to Smallport exactly equals the fair value of the assets less the liabilities. So in other words, what they paid for Smallport was exactly what it was worth. So there's no goodwill, there's no bargain gain on a bargain purchase price in this transaction. Okay, a couple things here. Let's go back to this first paragraph. What is the total price they paid? Well, they paid the $550,000 cash, and they paid 20,000. They issued 20,000 shares, and the current value of those shares is $100 a share. So that is equal to $2 million. All right. So the total that was paid was $2 million plus the $550 in cash, or $2,550,000. All right. So let's kind of remember that number as we go forward. Okay, so this is the calculation that I just did, the stock, the cash, and the total. Okay, now, this is the books of the companies. And the first column represents the books of BigNet, their book values as of December 31st. Okay, and then you have two columns for Smallport. First column is the book value of Smallport as of December 31st. And then there's the fair value of the net assets that were purchased. You notice, remember we said we paid $2,550,000? That's exactly what the fair value of the net assets is, $2,550,000. Okay, so this column right here, this fair value, is what we paid to buy, what BigNet paid to buy Smallport. All right, so those are going to be the important values, and when we're all done, that's the value we want on our books, is what we paid for it. We really don't care what Smallport had it on the books. We didn't buy Smallport's books. We bought Smallport at today's prices, today's values. So that's what we're going to be using in our transactions. Okay? All right, so how do we go about consolidating the financial information? First, legal and accounting distinctions divide business combinations into categories. Various procedures are utilized according to the following sequence. First, acquisition method when the dissolution takes place, which is what we're going to do first. And then we'll look at what happens when the acquisition method is used when separate incorporation is maintained, when Smallport and BigNet continue to exist. We'll do that one, but there'll be some differences in the data when we get there. All right, so let's go ahead and go through this. All right, oops, I missed it at the bottom here. When an acquired firm's legal assets is dissolved, the continuing firm owns the former firm's assets. So in this case, Smallport's going to discontinue to exist, and BigNet should have the value of whatever they were worth plus whatever they paid for Smallport when it's all said and done. Okay, so just to go back and look at the numbers, BigNet had net assets of $2,700,000. Everybody remember what net assets are? Just to kind of remind you, net assets are assets minus any liabilities, and that should equal your owner's equity, because if you remember back to the accounting equation, assets are equal to liabilities plus owner's equity. So if mathematically we take that liabilities and put them on the other side of the equation, it would be assets minus liabilities equals equity. Okay, so when we're all done, we should have one company with net assets worth $2,600,000, because that's what BigNet had before the purchase, and $2,550,000, the combination of what they bought from Smallport at fair value. So the combination should be, what is that? $5,150,000. Okay, so that's what we would expect to have on the books of the company when we're all done. Okay. Now, what is the journal entry, and how do we go about preparing that journal entry to record? Basically, the fair value, that $2,550,000, is transferred to acquire the dissolved firm. And then we put all of the assets and liabilities at their fair value on the books. And then, of course, we have to look at goodwill. The entry to record the fair value of the combination depends on whether goodwill is equal to or exceeds or is less than the fair value of the net assets of the firm dissolved. So we're going to go through the first example is exactly what we paid, and then we'll look at goodwill. Okay, so let's go ahead and look at Learning Objective 2.6a. We're going to prepare the journal entry to consolidate the accounts of a subsidiary if dissolution takes place. Okay, so if you remember, well, let me go back, and I'm going to go back and look at this. Whoops, went one too far. What we want to do is we want to show these items right here, all of these fair values in the journal entry, and we want to show them what was paid for them. Okay, and if you remember, what was paid was $2 million in stock and $550,000 in cash. Okay, so what's going to happen is on the journal entry, we're going to be, and this is the journal entry on BigNet's books. We're not looking at what's happening on Smallport's books because it no longer exists anymore. Okay, we're looking at how does BigNet handle it after they buy Smallport. Okay, so I'm going to move back to so what we're going to do is we took all of those net assets, the current assets, the computers and equipment, excuse me, the capitalized software, the customer contacts, and then also the notes payable, and that would be a credit because it was a negative amount. Those are all the things that we're going to include in the journal entry. Now, current assets. If we had more detail, you know, I would assume we would have more detail. We would do specific accounts like accounts payable, prepaid insurance, or whatever inventory, whatever those current assets are. We would actually take that $300,000 and split it between each one of those current assets. Then in terms of, okay, so this is up to the notes payable. This is what we got. We received all these assets. We also assumed the liability of $250,000 for the notes payable. What did we give? From here on down is what we gave to Smallport to buy them. First of all, we gave them $550 in cash, so that's going to credit cash because cash is going down. Common stock, we're going to issue 200,000 shares of common stock. Its par value is $10 a share. Okay, if you remember the 20,000 shares of common stock, the market value was $100 a share, so that's $2 million. However, what we put in the common stock account is always par value. Anything above par is going to go into the additional paid-in capital. So 20,000 shares times $10 a share puts $200,000 in common stock. The total is $2 million, so that leaves $1.8 million to go into additional paid-in capital. Okay, so that journal entry is pretty basic, pretty easy if the subsidiary is involved. Okay, now it gets a little bit more complicated. BigNet transfers to the owners of Smallport consideration of $1 million in cash plus 20,000 shares of common stock with a fair value of $100 per share in exchange for ownership. The $3 million consideration transferred from BigNet to Smallport results in an excess amount exchanged over the fair value of the net assets. And when that happens, what do we have? We have goodwill. Okay, so when the consideration transferred exceeds the total fair net value of the assets and liabilities, we're going to allocate it to goodwill. Okay, so if you remember in the last example that we looked at, the total fair value was $2,550,000. Okay, now at this time, and we paid exactly $2,550,000. This time we're paying $3 million. Boy, I'm having a hard time with numbers today. This time we're paying $3 million for all of small port. So the difference between the $2,550,000 of fair value and the $3 million we're actually paying, which is $450,000, that's going to be the goodwill, and that's how they got the goodwill. Okay, so here's an actual details of the calculation. They sold or gave them 20,000 shares of stock at $100 a share. That's $2 million. They also gave them $1 million cash for a total consideration of $3 million. They received $2,550,000 in net assets, and that gives them goodwill of $450,000. Okay, so our journal entry is not going to change a whole lot except for what we're doing with goodwill. Okay, so if you go back and compare this entry to the previous one, there's two real differences. Okay, one difference is we now have added goodwill as an asset. So we're going to debit goodwill for $450,000. And then instead of paying only, I think they paid $550 in the last example, we're paying $1 million. So we had to increase the cash to $1 million. That makes our debits, we increase the debit side by $450, we increase the credit side by $450. Now, how the company chose to pay that additional difference could have been by cash, but it also could have been by capital stock. In this case, they're trying to keep a lot of the example constant, so they kept the amount of common stock constant. All right, so overall, what the big difference and what, don't get too blown out by the differences between the two. The difference is we've added the goodwill because we've now paid more for it, so we think the company has something of value attached to it that we can't physically, come up with, or even an intangible, some of the intangible assets that are a little bit more easily identifiable, that 450 is goodwill, and then we have to adjust how we paid for it side to account for that. Okay, now what happens if what we paid is less than the net identified assets fair value? So in other words, in our example, we're saying the fair value is $2,550,000. What happens if BigNet pays less than $2,550,000? Okay, an exemption to the general rule of recording business acquisitions at fair value of the consideration transferred occurs in the rare circumstances of a bargain purchase. Basically, what happens in a bargain purchase, the fair value of the consideration transferred by the acquirer is less than the fair value received. We talked about that. So the fair value received is considered more relevant for the asset valuation than the consideration transferred. So what we do, and let's go through the example. In this case, what's going to happen is BigNet's only going to pay $2 million for the $2,550,000 in assets. So they're going to have 20,000 shares of stock at $100 a share for $2 million. No cash is going to be changed in hand. So they're only giving them a $2 million, but they're getting $2,550,000 in return. So there's a gain of $550,000. Okay, how would that show up in a journal entry? All right, the asset side of the books is going to be exactly as we would have done it under the first situation where we did not have either this goodwill or bargain purchase. And what happens here is the balancing point in the journal entry, the $550 gain, is shown as an ordinary gain on the bargain purchase. That's ordinary income, and that's going to be a credit. So that gain is what is the plug number, basically, to make the journal entry balance. And it should always be a credit. Okay. You know, how I always try to think of gains and losses. Gains are like income. They improve the situation with the company. Income account, you know, sales accounts, revenue accounts are always credited, so gains should be credited. Losses are like an expense to the company. They're not really an expense, but they affect the company in the same way as an expense does. And expenses are always debits unless it's some kind of an adjustment. You know, so any kind of loss would be a debit. And that's how I have always kept gains and losses straight in my mind and how to handle them.